Today, we are going to deep dive on retail industry. Walmart just released Q3 FY26 earnings. Revenue was $179.5 billion, up 6%. Comparable sales for Walmart US rose 4.5%. The industry metric, also called same-store sales, includes sales from stores and clubs open for at least a year. Walmart e-commerce sales grew by 27% globally, as all segments of the company posted sharp gains. Operating activity was $27 billion, investing $17 billion on payment in equipment and property. Financing was $7 billion, mostly on repurchasing shares. There are few metrics we can evaluate if the retailer is doing a good job. Walmart's gross profit margin, hovering around 24 to 25%, is considered typical for a massive, low-cost retailer. But its health depends on managing high operating costs against slim profits and leveraging high-margin services like advertising and memberships for overall growth, as seen in recent strong revenue growth from these areas. While gross margins are steady but slim, focus is shifting to their higher-margin digital ventures, which are boosting overall profitability. Walmart's inventory turnover ratio is generally considered healthy and efficient, indicating strong sales and good management. A ratio of about 9x means they sell and replace their entire stock roughly 9 times a year. A sign of effective operations for a massive retailer with low margins but high volume. A 7.9% ROA indicates Walmart is performing well operationally, making good use of its extensive resources to generate earnings, even with intense competition. Walmart's debt-to-equity ratio is high primarily because it uses significant debt to fund its massive, capital-intensive growth, including building and modernizing stores, distribution centers, and technology, while also managing heavy operating expenses and competition. Walmart P/E ratio around 40 is generally considered high for a mature retailer, signaling strong growth expectations or potential overvaluation. Though it reflects investor confidence in its omnichannel strategy amid some concerns about downside risk if growth falter. Next we have Costco. Costco is a perfectly executed example of our principles for building a durable, ethical, and highly profitable business. Costco stemmed from its exceptional business model. Extreme customer focus, low prices, high loyalty through membership, and ethical long-term thinking, making it a model of efficient, customer-first capitalism that we saw as vastly superior to typical retail. We admired its simple philosophy of passing savings to members, creating a virtuous cycle of loyalty and profits, epitomized by the $1.50 hot dog deal and vast parking spaces. It just released its earnings report last week. Q4 revenue was $67.3 billion, up 8.3% from the year-ago quarter, driven by robust membership growth, resilient traffic, double-digit e-commerce gains and margin expansion. CFO Gary Millerchip said e-commerce gains were one of the strengths of the quarter. Digital sales jumped by 20.5% year-over-year. Comparable sales, an industry metric that takes out the impact of one-time factors like store openings and closures, increased 5.9% in the US and 6.4% across the globe. In the first quarter, Costco opened 8 new warehouse clubs. Business centers tend to sell bulk items intended for restaurants and other types of businesses. Those additional locations bring its total store count to 921 around the world. Its renewal rate in the US and Canada was 92.2%, and its worldwide rate was 89.7%. Operating activities was $4.6 billion. Investing activities was -$1.3 billion in property and equipment. and financing activities was minus $1.1 billion, mostly in dividends paid. Costco's gross margins are low, around 11 to 15%, because it intentionally caps markups to offer rock-bottom prices, driving massive sales volume and customer loyalty, with the real profit coming from high-margin membership fees. This strategy, relying on low prices, huge volume, and efficient operations, like minimal advertising and warehouse-style displays, makes membership income the core profit engine, covering overhead. Costco's inventory turnover ratio around 13.24x for the fiscal year ending August 2025, indicating they sell and replenish their entire stock roughly every 27 days, showing highly efficient inventory management. Costco's return on assets, ROA, is considered very good, with recent figures around 10.5% to 11%, indicating strong efficiency in using assets to generate profit, significantly better than industry medians and showing a positive trend over the years. This high ROA, coupled with its robust membership model, signals excellent profitability and efficient operations. Costco's debt-to-equity, DE, ratio is currently low, around 0.20 to 0.28. Reflecting a strong reliance on equity financing, showing a healthy, conservative balance sheet with less reliance on debt relative to shareholders' funds. Costco's P/E ratio has been significantly high, trading at a large premium, around 48x-50x, suggesting it was overvalued and priced for perfection, even with strong fundamentals, leaving little room for error or upside until earnings catch up to the high stock price. Lastly, moving on to Target, its revenue was $25.27 billion, down 1.5%. Comparable sales decreased 2.7%. Digital sales increased 2.4%. Operating activities was $3.4 billion. Investing activities was minus $2.7 billion. Financing activities was minus $1.6 billion in dividends paid. Target's debt-to-equity, DE, ratio was high because it strategically used debt leverage for growth, funding operations and investments like share buybacks, which boosted returns, ROE, but increased risk, especially with economic pressures like inflation and supply chain issues impacting profitability, leading to scrutiny on managing debt relative to cash flow and earnings. Target's P/E ratio is low primarily due to investor concerns about its discretionary spending vulnerability. Rising costs, supply chain, healthcare, margin compression, tough retail competition, Walmart, Amazon, and slowing sales growth, signaling market skepticism about its near-term earnings power despite potential long-term value. A low P/E suggests expect slower growth or potential downturns. It can signal a value trap if problems persist.